course, in a low interest rate environment and rising levels of confidence and a growing property market as a result, new lenders are entering the market and there is a greater volume of funds looking to be placed in this sector. However, we constantly, in an agile way, review the market and our competitors and vary our borrowing rates to compete in this market, while always balancing the aim to deliver trust investors with a competitive rate of return. We've recently reduced our borrowing rates, as mentioned, to increase the funnel of potential loan applications and seeing good success in this regard. However, one thing we'll never do is compromise on the risk management or the quality of the loans that we take on. We will never take on loans that we don't believe fit our criteria. In addition to varying our rates, we have strengthened our resources across all 3 states and hired experienced portfolio managers in Brisbane, Sydney and Melbourne, as well as additional support staff in the areas of processing, and increased our presence in the marketplace through various marketing mediums quite considerably. There are several important ways that we mitigate risk. Firstly, each loan is secured by way of a first registered mortgage, so we are the senior lender, which gives us control to execute and manage each loan. Secondly, we have proven processes to manage the portfolio. Our lending committee meets weekly to review each loan with the portfolio managers on a direct basis, and so there's a high level of ongoing accountability with each and every loan. Our committee includes registered builders and quantity surveyors and other high skill sets which have a depth of experience in assessing the loans and ultimately making decisions around moving forward or not, and then of course project management along the way. As we obtain the monthly quantity surveyor reports, which are critical to the process, we can assess and review construction costs and time frames around the orderly completion of these projects. So we are likely to be aware of any construction issues arising, including cost-based or time-based issues. And of course, we're always working towards ensuring there are sufficient funds to complete the construction and sufficient time to allow the orderly sell down of the project and satisfactory repayment of the loan. Thirdly, as mentioned, our loan book is diversified, both geographically and by loan type, adding further risk mitigation. Our loan book is well diversified across Australia's eastern seaboard. As at 31st of March, the geographic spread was 45% in Queensland, 32% in New South Wales and 23% in Victoria. Another layer of diversification for investors is also product type and loan type. Currently 60% is financed with residential construction activities, 29% of the loan book is land construction activities, mainly subdivisions, and the rest is set against commercial and industrial construction, as well as completed stock, both industrial and commercial. But our preferred area of focus continues to be medium density and low density residential construction, areas which appeal to the broadest range of social demographics and target markets. And fourthly and importantly, we also capitalise on the experience of our team, many of whom have decades of experience as property lenders and bring that to the table. So in both construction and marketing a final product, together with all the delivery elements, we're intensely focused on ensuring that our borrowers achieve a successful result. Well, as we enter the second quarter now for 2021, the demand for residential and commercial properties continues strongly, and that's a positive for our loan pipeline going forward. It's also a positive for the repayment forecasts as well with respect to existing loans, as we're seeing and mentioned earlier. So the monthly income trust will experience ongoing benefits from confidence in this sector, basically on a national basis. Developers, we believe, will continue to take advantage of buyer appetite and fast-track new projects where they can access the sites and obtain the approvals at financially viable prices. So we continue to expect to see strong sales results going forward. We're seeing that now. We'd expect to see that on an ongoing basis and certainly over the year ahead. Although, as a result of all those things mentioned, there may be some growing pains in the sector in this rapidly changing marketplace that we're in. And over the next 6 to 12 months, we expect that might stabilise and reach some equilibrium as confidence continues to strengthen in the sector and the mid-long-term prospects for residential property remain assured. The areas holding most appeal, we think, over the next few years will certainly be the residential sector and also the industrial sector. Residential in particular will continue to perform well because we're starting to see now lower levels of vacancy rates. Renters are feeling more confident to join the marketplace or rejoin the marketplace in some cases. We're of course seeing significant interstate migration into Queensland, but also intrastate within all of the states, and lots of new markets emerging as high growth centres. So the interstate migrations, coupled with more younger people moving out of home and into their own apartments as the economy recovers, will continue to drive vacancies lower in our view. These lower vacancies will ultimately lead to price and rent increases in due course if things work in the normal course, and ultimately drive investors back to the marketplace as well, a critical element perhaps missing to some extent in the current market. But we'd expect to see investors move forward, particularly in a low interest rate, reasonably good return environment. So these factors are all driving increased activity in the residential sector, and some commentators are even predicting double-digit growth over the next year or two. So that's residential, but with respect to industrial, we expect that to continue to remain a very attractive asset class as well. And on a diversified basis, we continue to look in this sector. Certainly demand for industrial property over the last 12 months has increased exponentially because manufacturing, for example, has benefited from the current low Australian dollar environment, and our goods are globally competitive. And as a result of that, and the strong local Australian economy, we're seeing significant confidence in the industrial space. We're also seeing increases in commodity prices as well. Raw materials such as coal and iron ore and copper making, all of which go into manufacture and steel making, have all performed well on a national basis, and that supports the underlying industrial activity, as does logistics and logistics development driven by e-commerce and the like, where we'd expect to see more distribution centres and warehouse and transport centres build out across the country. So we'll continue to source potential loans in the industrial space as well for the sectors that we like, which is industrial construction and industrial land subdivision. And we're also strategically looking for opportunities at all times to add to our Trilogy Industrial Property Trust.